Ever wonder how money is created? You might think it's all about printing bills. But the truth is way more interesting. Most money is actually created by banks. Yeah, you heard that right. It sounds crazy, but it's true. Here's the deal. When banks give out loans, they're essentially creating new money. It's not magic though, it all boils down to something called fractional reserve banking. Imagine you deposit $100 into a bank. The bank doesn't just hold on to it, they keep a fraction of that deposit, say 10%, as reserves. The rest? They lend it out to someone else. That borrower then uses that money and it might end up back in another bank account. This cycle repeats, and with each loan, more money enters the system. This process is how banks literally create money out of thin air. It's a powerful system that fuels economic growth. But, like any powerful tool, it needs to be used responsibly. Let's break down how this money creation actually works. Remember that $100 deposit? Well, if the bank keeps 10%, $10 in reserve, they can lend out the remaining $90. Now that $90 goes back into circulation, potentially ending up in another bank. That second bank can then lend out 90% of that, which is $81. See where this is going? This cycle can repeat over and over again, with each loan injecting more money into the economy. This is called the money multiplier effect. The initial deposit of $100 can actually lead to the creation of much more than $100 in new money. The money multiplier effect is a key driver of economic growth. It allows businesses to invest, people to buy homes, and the economy to keep humming along. Now, you might be thinking, wait a minute, if banks keep lending out most of their deposits, what happens if everyone wants to withdraw their money at the same time? That's a great question, and it highlights a crucial point. There's actually not enough physical cash in the world to cover all the deposits in all the banks. Whoa, right? Banks operate on the assumption that not everyone will want to withdraw all their money at once. It's kind of like a massive game of musical chairs, where there are always enough chairs, until there aren't. But if everyone did try to withdraw their money at the same time, a situation known as a bank run, it could lead to a whole lot of chaos. Bank runs, a blast from the past. Bank runs are a scary thought. You've probably seen them depicted in movies, long lines of panicked people outside banks, desperate to get their money out. It's not just a Hollywood invention. Bank runs have actually happened in history, and they can be devastating. Remember that game of musical chairs? If everyone rushes for a chair at the same time, someone's going to be left standing. In a bank run, those left standing might not be able to access their money, even if it's technically theirs. Luckily, we've learned a lot from past bank runs. Regulations and safeguards are in place to prevent them from happening, and deposit insurance protects your money up to a certain amount. The Fed, our financial superhero? So, who's keeping an eye on all of this? Enter the Federal Reserve, also known as the Fed, America's central bank. The Fed plays a crucial role in maintaining the stability of our financial system. Think of the Fed as a financial referee. They set interest rates, lend money to banks, and generally keep an eye on things to prevent financial meltdowns. They're like the adults in the room, making sure the banking system runs smoothly. The Fed's actions have a huge impact on the economy. By controlling the money supply and setting interest rates, they influence everything from inflation to unemployment. Keep the conversation going, so there you have it, the inside scoop on how banks create money. It's a fascinating and complex system that impacts all of us. What do you think about the power of banks to create money? Let me know in the comments below. Don't forget to like this video and subscribe to the channel for more eye-opening content about finance and the economy.